Hello everyone, and welcome to my appraisal report. The house I chose is 17 Boyden Road in my hometown of Medfield, Massachusetts. The house has 5 bedrooms, 4 bathrooms, 4,204 square feet. It's on a 1.99 acre lot, and it was built in 1992. So the town of Medfield currently has a population of 12,000 people. 50% have children under 18, 73% of households are married, and the median household income is $133,931, making this a fairly expensive place to live. On the right here is a zoning map, and the subject property is located in this neighborhood right on the edge of the residential sector of town. The house was built originally in 1992 and sold for $425,000 that year. That owner held it till 1999, where it was sold for just under $600,000. That owner lived there till 2016, where they sold it for just under $1 million, and they listed it again this year for just under $1.1 million. The comparable properties I chose, 4 of the 6 were all in the same neighborhood, and these other 2 were in nearby neighborhoods that are fairly similar. All these houses were in the same circle I put on the zoning map in the previous slide. For the sales comparisons, most of the houses I used were fairly similar, which meant they didn't require a tremendous amount of adjustment. The only house which required a significant amount of adjusting was comparable to here. This house was substantially smaller than the subject property, both in square footage and lot size, and because its previous selling price didn't reflect that, the adjustments I used pushed it far higher in value than it should have been. But for sales comparison, the final adjusted price I reached was $1.2 million, give or take. The cost approach, I used costtobuild.net to estimate the cost of the building, which came out to $731,234. The cost of the land, I used the same method I used for the sales comparison adjustment, which was taking a lot that was for sale on Zillow and multiplying that to get the correct acreage for this house. And depreciation, I used straight line depreciation for the house over an economic lifespan of 80 years because this house clearly had been well maintained and updated over its lifespan. For the income approach, I used an estimated monthly rent of $9,000. I found estimated market cap for the local area at 5.56%. Operating expenses were estimated at $8,000. Vacancy and collection costs were 5% of rent, and estimated NOI came out to be $92,800. That divided by my market cap rate gave me a price estimate of just under 1.7 million, which is a little high in my opinion. The discounted cash flow, I used a holding period of 10 years. NOI for each year was the same as the direct capitalization method of 92,800. The discount rate was 4.211%, which I calculated using a mortgage calculator. And the selling price after year 10 was the same as in the direct capitalization method because I was not able to find a terminal cap rate for the area. This gave me a final valuation of $1.8 million. So for my reconciliation of value estimates, the sales comparison, this top line here, was definitely the closest. It came in just above what the list price was. So I gave that 80% weight because that was definitely the best method to use for a property of this type. Cost came in fairly low, and because the data just wasn't as consistent, I decided to give that a much lower weight. The income was the hardest ones to estimate because there was very little data for a property of this type in terms of rent in the area. And because of the inconsistencies of data and just that it was an inappropriate method in general for a property of this type, each of these methods got 5% in weight. So those all multiplied together gives me a reconciled final valuation of $1,243,469. This I feel like is actually, I was surprised at how close I got to the list price of 1.1 million. And while the house had only been on the market for a few days, and while I've been working on this presentation, it actually has a sale pending already, meaning that it was likely priced to sell. So I feel like this was a fairly good estimate for what I was expecting. So for the impacts of coronavirus, especially economically, markets are currently attempting to price in the risks posed by the coronavirus, because we're not sure what's going on or how bad it's going to be. This is causing a ton of volatility, especially in stocks and other markets. There hasn't been much of an impact on the housing market yet, but that's usually a much slower market to react. Unemployment has hit its highest level in recent years, which will definitely cause a decrease in buying power for the average American. To try to combat this, Congress has passed the CARES bill, which allocates $2.2 trillion in relief funds, which is a very considerable amount considering 700 billion was what was allocated after the financial crisis in 2008. Furthermore, I think we're just at the beginning of this. Although there's not much information on the subject, CDOs, which were a major cause of the financial crisis and were talked about a lot in The Big Short and other movies, those have drastically increased in trading volume in the past decade. Then whether or not they're fraudulent, like what happened in the years leading up to 2008, the median US home price has risen to a level only seen during the peak of the housing bubble, and this is adjusted for inflation. So it's likely we'll see a steep decrease in the housing market. But like I said, the situation is still unfolding, so at this point, no one really knows what's going to happen. But that is the end of my presentation. I hope everyone is staying safe out there.